Dr. Michael Burry. You probably know the name from The Big Short, where Christian Bale played him as the eccentric fund manager who saw the housing crash coming before almost anyone else. But outside of Hollywood, Burry has become one of the most fascinating and unpredictable investors to follow in modern markets. Over the past decade, he's gone from shorting the housing bubble, to calling post-COVID inflation before it hit, to backing GameStop before it exploded, and even betting on Chinese tech stocks when sentiment was at rock bottom. Boo. Here's the thing. While Burry is famous for spotting long-term trends, he often acts like a short-term trader. And that's exactly what we're seeing in his latest move. In Q1 of 2025, Burry did something extraordinary. He sold almost everything. His $77 million portfolio from last quarter cut down to just $13 million. And instead of staying on the sidelines, he placed big put option bets against the very same companies he was bullish on just months before. Why did he flip so fast? And what can we, as ordinary investors, actually take away from this? Let's break it down. To understand how shocking this move really is, we need to compare Burry's portfolio from just a quarter ago to where it stands today. At the end of last year, Burry's Scion Asset Management held about 13 positions worth $77 million. His biggest conviction plays were in Chinese tech companies like Alibaba, JD.com, Baidu and Pinduoduo. For nearly 2 years, these positions signaled that he was betting on a long-term recovery in China, despite global skepticism. To many, it looked like classic Burry, finding solid businesses that the market had unfairly punished. Fast forward just 3 months to Q1 2025, and it's a completely different picture. The portfolio has collapsed to only $13 million in value. Almost everything is gone. Alibaba gone, jota de Kong. Gone. Baidu? Gone. Even his secondary positions are gone. The only stock that remains is Estée Lauder. That's it. From a dozen holdings spread across industries and regions, to one single company in cosmetics. On the surface, it looks like Burry has abandoned almost every growth thesis he has held for the past couple of years. But the story doesn't end there. Because not only did he sell nearly everything, he also flipped his stance entirely. Instead of simply exiting and holding cash, Burry went back into the market with put option positions. And here's the kicker. Those puts were aimed squarely at the very same Chinese tech stocks he once supported. So, what could make an investor like Michael Burry abandon a 2-year thesis in just 3 months and not only sell out, but turn around and bet against the same companies? The answer lies in geopolitics. In January, the US and China escalated into a full-blown trade war. After Liberation Day, the Trump administration slapped blanket tariffs as high as 67% on a wide range of Chinese imports. China hit back with tariffs of their own, going as high as 125% on American goods. And the US doubled down again, raising tariffs on Chinese exports to 145%. Now, while the situation has technically been paused for 90 days, for an investor like Burry, the damage was already done. His Chinese tech bets were no longer just about fundamentals. They became pawns in a political standoff. Think about what tariffs mean for companies like Alibaba, JD or Baidu. Consumer demand gets squeezed. Supply chains face disruption, margins shrink. Investor sentiment tanks. On top of that, there's the constant risk of US delisting threats, capital controls, and new regulations. So instead of being undervalued gems waiting for recovery, these stocks suddenly looked like prime short candidates. If you believed global trade was about to break down, or at least stay messy for the foreseeable future, shorting Chinese tech would be one of the most direct ways to play it. That's exactly what Burry did. He opened put positions against Alibaba, JD, Baidu, and Pinduoduo. He even extended the bearish stance to Nvidia, US darling, trading at lofty valuations, and Trip.com, another Chinese company heavily exposed to global travel demand. This was a full 180, not a cautious retreat, but an active bet that markets, especially Chinese equities, were headed for pain. Now let us talk about the 2 names in Burry's put option list that stand out. Nvidia and Trip.com. Nvidia is a fascinating choice because, On the surface, it looks like the one stock you wouldn't want to bet against. Over the last few years, Nvidia has been the crown jewel of the AI boom. Its chips power everything from machine learning to data centers, and the company has been printing record revenues. Investors love it and its stock price has soared. But here's where Burry's contrarian instincts kick in. Nvidia is also trading at a price-to-earnings ratio north of 40, a level that leaves little room for error. When a stock is priced for perfection, even small disappointments can trigger massive sell-offs. For Burry, who has never shied away from shorting the most hyped companies. Remember his bet against Tesla, it seems Nvidia looked ripe for a reality check. Then there's Trip.com, China's biggest online travel agency. At first glance, this one makes sense within his broader bearish China theme. While Trip.com does operate internationally, its headquarters are in Shanghai, and much of its demand is tied to Asia-Pacific travel. Tariffs, economic uncertainty, and reduced cross-border tourism could all weigh heavily on its business. So with Nvidia, Burry is targeting valuation risk. With Trip.com, he's targeting geopolitical and economic risk. Put together, they round out a picture of a portfolio that's not just defensive, it's aggressively betting on turbulence. But here's where it gets interesting. Despite all these puts, there's still one lonely stock sitting in his portfolio. And that's Estée Lauder. So, with Burry selling almost everything and shorting half the market, why on earth would the only stock he kept be Estée Lauder? On paper, it looks odd. The company hasn't exactly been crushing it. Revenue has been trending down. Net income even slipped into the negatives. Demand in Asia-Pacific, especially China, has been weak. And their travel retail business, think duty-free shops, cruise lines, airport sales, has struggled post-pandemic. To make matters worse, Estée Lauder has announced job cuts and restructuring just to stabilize profitability. But the contrarian appeal. Estée Lauder has been absolutely crushed by the market. Its stock is down nearly 80% from its 2021 highs, trading at levels we haven't seen in almost a decade. For a brand with global names like MAC, Clinique and La Mer, that kind of sell-off raises eyebrows. And here's where the lipstick index comes in. This idea, first coined by Leonard Lauder, suggests that during economic downturns, consumers cut back on big luxuries, but still treat themselves to small indulgences, like a $30 lipstick instead of a $3,000 handbag. Best thesis holds. Cosmetics companies like Estée Lauder can see a resilience in demand, even when the broader economy struggles. Now, whether Burry truly believes in the lipstick index, or simply sees Estée Lauder as a beaten-down value play, isn't totally clear. But knowing his history, it wouldn't be surprising if this is a classic cigar, but in a spent company so beaten down that even one puff of good news could send the stock higher. In other words, Estée Lauder might not be Burry's long-term conviction play. 2. It's more likely a short-term opportunity to catch a rebound before exiting with profits. Now here's the million-dollar question. What can the average investor actually take away from Burry's S13F filings? First, we need to remember that Michael Burry doesn't play the same game as Warren Buffett. Buffett's 13Fs are valuable because when Berkshire buys something like Apple back in 2016, you know it's probably staying in the portfolio for a decade or more. That gives long-term investors a chance to ride alongside him. Burry, on the other hand, is a different beast. See, he thinks like a value investor, but acts like a trader. He's not afraid to pivot 180 degrees in a matter of weeks. That means by the time we even see his filings, which are delayed 45 days, he may have already exited or flipped those positions again. So while it's fascinating to track his moves, we can't just copy them. His filings are a snapshot of the past, not a live roadmap for the future. What we can learn is mindset. Burry isn't afraid to challenge consensus, to go against hype, or to cut ties with a thesis the moment conditions change. Whether it's shorting housing in 2008, predicting inflation when it was at 2%, or flipping bearish on China in the face of a trade war, he has proven again and again that flexibility and conviction can coexist. And that's the real lesson for us. Don't marry your investments. Stay open to changing realities. And don't assume that because a stock looked attractive last quarter, it's still attractive today. So there you have it. In just one quarter, Michael Burry went from holding a $77 million portfolio packed with Chinese tech stocks to selling nearly everything, betting against his own positions, and leaving just one lonely company behind, Estee Lauder. Whether you see this as genius contrarian timing or just short-term trading, one thing's clear. Burry continues to keep everyone guessing, and maybe that's the point. He's not trying to build a fan club, he's trying to make money. For us as investors, the takeaway isn't to copy his trades, but to watch how he thinks. The courage to pivot, the discipline to take profits, the willingness to go against the herd, those are lessons worth paying attention to, no matter what stocks you own. If you enjoyed this breakdown of Michael Burry's Q1 2025 portfolio, do me a favor, hit the like button, subscribe, and turn on notifications. That way you won't miss future updates on 13F filings, market news, and investing strategies. And now I want to hear from you. Do you follow Burry's moves closely, or do you think he's too unpredictable to learn from? Drop your thoughts in the comments side. Love to see where you stand. Thanks for watching, and I'll see you in the next video.